All right, let's get started. Once again, a good morning to everyone. I wanted to start not by looking at achievements, but rather at the announcements. Yesterday, I sent you guys a few things. Sorry if it was a lot of emails, but hopefully it was helpful. There were two career-related opportunities that crossed over my email, so I thought I'd share them with you. One of them, as you can see over here, is that Apple will be hosting some virtual sessions for specifically for LaGuardia Community College students. This has got to do with I guess getting work at Apple, resume tips and so on. Even if you're not necessarily interested in working at Apple, I know that this time is obviously during our class time, but the second one is not. It might be during another one of your classes. But I think if you register, you would be able to, excuse me, get a like a copy of the recording of the session, because I think these days the Center for Career and Professional Development, which is the organization that's sponsoring this event, is recording most, if not all, of the virtual sessions that they are hosting. So again, even if you can't make it, you may just want to at least register so you can get information, maybe even on future events that they're hosting. The other one, opportunity number two, is also from the CCPD, which, you know, when we're on campus, if you've ever gone to their office, it's in the B building on the first floor. But right now, again, they're doing a lot of work to try to help students to find work, and internships and stuff they're doing online. And right now they're working on, I guess, what they're calling micro internships that happen year round. And the reason it's micro is because it's a very short stint where you can actually work remotely with companies. And I guess what they're trying to say here is that if you are interested, you could register on this platform, fill out a profile and review any micro internship projects that are available, and then apply, and you may be able to be placed. We're talking about working at startups, working in sales, marketing, technology, HR, finance, you name it. If you guys are interested, or if you have more questions, you can contact me separately about this. But I'm bringing it up because I know that at this time, maybe some people are looking even for something to do remotely to earn some extra money. I do also have another, and I don't have it up now, I'll bring it up later. I do also have another opportunity that, again, if someone is interested, you can contact me directly. It's working remotely to do what they call contact tracing for COVID-19. So you get trained remotely and then you work remotely, and contact tracing is basically obviously trying to trace infection and so on, to see, I guess, what the patterns are as it relates to COVID-19. Again, this may not be of interest to many of you, but it's paying fairly well, and it's something that you can do from home. So I'm bringing it up just because I know for some people you had jobs that were maybe in person or client facing, and you are no longer able to do those things. So whatever I'm seeing around working remotely, I'll continue to share with you. Then the last thing that I just wanted to bring up, I sent this also yesterday. May is Mental Health Awareness Month. This time of being on pause or lockdown, whatever you want to call it, and being so far removed from everything, and also having to go through distance learning and all of the changes can cause a lot of stress for many of us, including me, honestly. So I just wanted to share resources with you. They're all here. This is NYC Well is the city's response to this, to needs for mental health help. It's a free service, and they can also refer you out to mental health professionals. Also, the school is having these You Are Not Alone distance learning sessions where people are able to just join and speak, and they're recording the sessions. So if you just want to watch it and see if maybe you're interested to join, I think they're having it like every other Tuesday or something like that, from about, I think it's from 1 to 2:30. And then I know some of you have classes during that time, but I'm just bringing it up. If you can't join, you can maybe just RSVP and then get access to the recording. And then LaGuardia has all these virtual support circles that happen every day of the week, and there are various themes, as you can see. So please also look into that if some of these themes apply to you. There, if you click on this link, you'll be able to see how to connect with the virtual support circles. And then finally, for those of us who are immigrants, I'm also an immigrant, many of you are, and you might need some help with just about anything really. If you have questions to ask and so on, if you click on this link, it goes to the city's page for resources for immigrants in multiple languages. I think it's in 10 languages, just regarding your rights and resources that are available in this time, all right, of crisis and I guess anxiety that many people are going through. So those are some resources. You may or may not need them or use them, but if you think that they might be useful to others that you know, please don't hesitate to share them. I mean, it's not related to our class specifically. It's related to the whole school. So, if there's someone else in your circle that you feel might benefit from this, go right ahead and share it. Any quick questions about these resources, or are we good? Okay.
I think we're good.
Okay, so thank you. So going, I want to see if there's really, from an administrative perspective, there's really not much that I can I'm trying to just think if there's anything I need to remind you guys about. I guess the only thing I would say is, and you kind of know this already from the deadlines page, is that your chapter 15 homework is due on the 13th of May. So, keep going with that. Try to make sure that you're pacing yourself. I know this is a very, very busy and stressful time of the semester with a lot of midterms and tests and papers due and so on. I just don't want you to lose sight of doing the homework. You still have quite a bit of time, but again, don't leave it till the absolute last minute, because then it just starts feeling like the work is much more difficult than it actually is, because you're feeling under time pressure. So the 13th, excuse me. Sorry, I don't know what I just did. Oh, I made a comment by accident, sorry. The 13th of May, which is next week, Wednesday. So you still have a week, and you also still have 2 days of office hours with me if you have questions. And you can also send me screenshots of your work if there are things that you are getting stuck on, no problem. All right. Today we will go over start where we left off the last time, which was with the mortgage notes payable. And if you looked at the blackboard, or if you're looking at it now, you'll see that we will likely also start a little bit on chapter 17, because chapter 15 won't keep us busy for the entire session. So, if you need to pull down the chapter 17 handout later, it is there on Blackboard under the Zoom call materials. Also, just a reminder for those who haven't been able to make these meetings for whatever reason from time to time, all the recordings are in the playlist for our class on my YouTube channel, and you can kind of go back. I put them by date, so if you know the date that you missed, you can catch up on those lectures. All right. Okay, so we said yesterday that part of long-term liabilities is also long-term notes payable. A note payable is, the long name for that is a promissory note, which means a promise to pay a balance in the future. If we're saying long-term, we're obviously talking about something that is due in more than 1 year from the balance sheet date, right? So it's not going to be promissory notes or notes payable for a few months, whatever. It's going to be a year or more. And since we're focusing on mortgage notes payable, you may recall, even when we were talking on Monday, we were saying that in general, in the US, a mortgage is for about 30 years, 30. Sometimes people take a shorter term. Where I come from, a mortgage, the maximum amount of years that you get to pay is 20 years. So it could be, anywhere within that time frame, but it's definitely more than 1 year. However, remember that, and I'll just type this here, any portion of the mortgage, right, of the mortgage that is due within the next 12 months will be classified as current liabilities. Right, that should make sense to you, because we're saying, okay, I take out, so I take out the 30-year mortgage, right? I take out the 30-year mortgage on May the 6th, 2020, right? All payments due until May the 6th, 2021 are current. Anything after that date is long term. Okay, so think about that. This is an important point, because not only just to answer homework questions, but I mean, there is a question in your homework that asks you to split, a balance that is owed between how much of the balance is current and how much of the balance is long-term. And you need to be looking at the date is important, right? What is the date that that I am standing at, right? If it's today, I have to count from today. I basically count 12 months, and I say, so the 12 payments that I'm going to make, right? If I'm making monthly payments, the 12 payments I'm making from today until next year, May the 6th, that's going to be current. And then anything after that is going to be long term. So on day one of the mortgage, it's going to be 1 year is current and 29 years is long term. This is important because of how we build the balance sheets. Remember, the balance sheet separates current and long term liabilities. So if a company does take out a mortgage note payable, they have to be sure to show the users of the financial statements the portion of the mortgage that is due within 1 year and the portion that is due after 1 year. Why do you think users of financial statements want to see current and long-term liabilities split up like that?
To do an accurate balance sheet?
Can you speak up? What did you say? Sorry.
To do an accurate balance sheet?
Yeah, and so it is accurate, but tell me more about, if you were looking at a company's financials, its accuracy, but also, is there anything else? Like, is there a difference if I told you I have debt of $10,000 and I say, but it's a student loan that's only due in 4 years versus a loan that is due in 3 months? Do you think there's a difference there?
It's easier to report and read.
This money doesn't have to be paid now, so it's
yeah. So that's where I'm headed with, when users look at financial statements, they are often concerned with what does the company owe, in the near future, and they compare that to the amount of cash that the company has on hand, and that's usually called the current ratio, which we'll deal with more in chapter 18. But the point is, there is a big difference between having a debt that is owed within 1 year versus, you know, in a number of years, because users will generally say, well, if you only owe that money, you know, more than a year from now, you still have time to figure it out. But if you owe it within 1 year, and we don't see that you have enough cash to pay it, you know, there's a little bit more urgency. And you may have noticed, I don't know if you guys have been seeing this. I saw yesterday that, did you guys see that J. Crew declared bankruptcy? And we've got a few other, I think it was JC Penney is not able to pay their debt. Are you guys seeing these things in the news? Or not really? Sounds like the answer is no. Okay. So if you know, I know that there's so much going on, and I'm sure your life is like super busy, but as a you know, as a business student, you just want to try from time to time to just look at the headlines to see what's going on in the business world. So this is J. Crew is filing for bankruptcy. They have too much debt. They're not able to pay their debt. And then, I mean, if you, there's actually an article that that I was looking at yesterday that was listing all the companies that are struggling right now because of, you know, obviously the drop in sales. So I'm saying that, or bringing this up to say that, you know, if these companies, if users are looking at these companies' financial statements and they see how much is due within 1 year, and they realize, you know, based on maybe an earnings call or something, that the company is not making the revenue that it needs to make to have the cash to pay, excuse me, these balances, then eventually it's going to become a situation where the company won't be able to pay its debt, and you could end up, I know we're in a pandemic, obviously, so things are extremely magnified, but under normal circumstances, if a company can't cover the current liabilities, then there's going to be a problem anyway. All right. So what do you need to know? That obviously what's happening in the world, but also how to tell if something is current and how to tell if something is long term. We said obviously that when you take out the mortgage initially, it is at face value, meaning at whatever amount you actually borrowed. So if I want to go buy, you know, a new home or something, and I have to take out a mortgage, and these days it's very expensive. So let's say I have to take out, you know, 600,000, and the rest I'll put a down payment. Whatever I borrow from the bank, that 600,000 is the cash that I receive, but obviously it immediately gets paid to the seller, and then I owe them, right, 600,000 in the mortgage notes payable. So there's no discount or premium or anything like that. It's just whatever the amount is. And then we make journal entries for each installment. I went over this also on Monday, saying that a mortgage installment is a fixed amount of money that you pay every month. It doesn't shift unless you have a variable interest rate on your mortgage, and the mortgage, I mean, excuse me, and the Fed changes the interest rates. But for the most part, you know, for our work, we're just going to have fixed interest rates. So you don't have to worry about the interest rate changing at some point during the mortgage. So you have the same cash amount that you pay every month, or if it's a yearly thing, every year. And then, excuse me, and then some portion of the mortgage liability is decreased, and the other part is interest expense, the cost of borrowing from the bank, right? Because the bank has to make money for the fact that they are allowing you to use their cash to buy this property. And so I already kind of said this, that the amount of the mortgage that is due for the next year is the current liability, and any unpaid principal balance is the long-term liability. So anything due more than 1 year from that date. Principal and, you know, the amount owing, all those things mean the same, and it's all shown in an amortization schedule, which yesterday I was explaining, and I'll go back into the book, and we'll also make our own amortization schedule. But let me just show you, sorry, I'm in the wrong thing here. Read, study, practice. I'll just remind you again about the amortization schedule. So this is what it looks like. Let me read what they give as the illustration, and then, like I said, we'll do our own examples so that you can actually get the feel for calculating it. So Porter Technology Inc. issues a $500,000. So there's the principal amount, right? 8%, that's the annual interest rate. 20-year mortgage, that's the term of the mortgage. On December 31, 2020, that's the issue date. So that's the date that they actually borrow the money to obtain needed financing for a new research laboratory. The terms provide for annual installments. So there you have to pay attention, because depending on how often a payment is made, right, that changes the interest calculation, and obviously then also changes the amount of the principal that gets reduced. So annual installment payments, you should already be anticipating that they will be the same amount every year, right? Because they have a fixed interest rate over year of 8%. So we set up the table like this, where, you know, sometimes it's dates here. In this case, they're just saying for year 1, year 2, year 3, year 4, right? That's the, you know, the time period for when they're paying. The cash payment column is the installment amount. So you can see that it's a fixed amount. So when you're building an amortization table, at whatever point maybe you have to do it to calculate something to put into Wiley, you should already know that the cash payment is always going to be the same. The next column is interest expense. So this is column A, B, C, D. It's telling you that interest expense is calculated as D, which is the principal balance, multiplied by 8%. We don't have to divide by 2 or divide by anything, because the installments are annual, right? If the installments had been semi-annual, then the 8%, right, you would have to look at it for every 6 months. So it would, in essence, be 4%, right, of interest for every installment period. Then the reduction of principal, that is calculated by saying how much is the installment minus all the interest that gets eaten up by the installment, tells us by how much the principal amount is actually going to be reduced as a result of that installment payment. So you can see over here on the issue date, you have this one line of 500,000. Remember, when you first take out the mortgage, they're not going to charge you interest on day one. So you cannot have, and they're not going to ask you to make an installment on day one either. So you cannot have installment payments already on the first date. This is just when you get the money, right? And then this 500,000, you can see they're saying you take the balance that is here and you subtract the reduction in principal from it, and that gives you the new principal balance. And of course, they're not showing you this calculation for 20 years, but hopefully it makes sense to you that by the time the 20 years are up, the principal balance would be reduced to 0, right? Because you're paying off the bank as calculated that if you make this payment of 50,926 per year over, 20 years, then you will actually end up paying the entire thing off. Questions on the mechanics of the table? Anybody need me to go over something again? Okay, so let me ask you this question. Tell me, somebody, how much money does this company actually end up paying for the new laboratory? How much in total do they actually end up paying? Try and do some calculations, or tell us how you think you would calculate how much the company actually ended up paying after 20 years for this mortgage that they took out. I'll give you a hint, right? You're paying $50,926 per year, and the term of the mortgage is 20 years. Yeah, so Tuba is saying just multiply it out, you're right. And when you multiply 50,926 by 20, you come out to how much? Tuba, did you do the calculation? I don't know if you have a mic that you can talk. Otherwise, I'll just say it. It's 1,018,520. That's how much the company ends up paying, because they are taking 50,926 per year multiplied by 20 years. So even though they only borrowed 500,000, because of all the interest that they have to pay over time, they end up paying more than double the mortgage amount for the property, for the lab that they built. What do you think about that? What do you guys think?
Extra broke.
Sorry?
Extra broke.
Yeah, and so this is and so this is why I was saying, when you are taking out a car note, or you're thinking about taking a mortgage, or whatever you're doing that is some type of borrowing that will involve installment paying over time, the bank doesn't always provide this. And I remember one of my colleagues, when he was buying his home, he actually asked, because he also teaches accounting, so he knows all this stuff, so he asked the bank for an amortization table to see his payments, and the person at the bank actually said, "Oh, how do you know about that? Like, why are you asking for that?" So it just tells you that sometimes the bank has these things at their disposal, but they don't necessarily provide it to you. But it's your right to ask for it. It's your right to ask for an amortization table. And if they say they don't have one, then you can tell them, "Can you please create one?" Or if not, I mean, you guys can see how it works over here. This is easily reconstructed in Excel, and you would be able to do it yourself to see what you're actually ending up paying. Because the worst thing that you can do is say, "Oh, I borrowed 500,000, so I'm assuming, I'm just going to be paying $500,000 plus 8%." And yes, you are paying, those are the terms, but unfortunately, things become a little bit more complex than that. So it's always just good to know when you set out on one of these things, especially with something like a car that's a depreciable asset, right? If you go into a lease or whatever with a car note, just try and figure out how much are you actually paying. I'm not saying that you shouldn't take out the lease. I'm just saying know what's happening in your wallet when you make these decisions. So for this transaction, the first thing that we do is we record the mortgage loans on December the 31st. When the company takes out the mortgage, you debit cash for 500,000 and you credit mortgage payable for 500,000. And then if you want to record installments, right, or if you are required to record installments, which you normally are, what's nice about this amortization table is that you actually have all the information that you need, right? Because this 50,926 is what you're going to be using to credit cash, right? That's the payment that is being made. The 40,000 is the debit to interest expense, and the 10,926 is going to be the debit to the mortgage payable account. So you can see here, these are the same journal entries like what we were looking at in our notes, except that now it's actually showing, the amounts next to them. So debit interest expense for 40,000, debit the mortgage payable for 10,926, and the cash is always a credit at 50,926. And I mean, if you were asked to do 2 years of installments, then you'll just move on, to the next row of information and just keep going. And so what they ask you over here, or what they discuss over here, and I just like to go over this because this is something that comes up in your homework as well, right? We've already discussed this amongst ourselves, that in the balance sheet, the reduction in principal for the next year, right, is the current liability. So be careful here. This is very specific. It's the reduction in principal that reduces the liability, not the entire installment. So if someone says, well, how much of this liability is current for next year, you're looking at the piece that is actually reducing the principal, not saying, oh, this entire payment is going to reduce my balance, because it won't. Some of this is going to end up in the income statement as interest expense. So just to continue reading, the reduction in principal for the next year is the current liability. And the company classifies the remaining unpaid balance as a long-term liability. So now go with me here, and please ask me to repeat if you don't follow. So at December the 31st, 2021, right, which is after the year, the first installment payments. Remember, we took the mortgage out on December 31, 2020. Then in year one, we make this payment. So at the end of year one, we still owe 489,074, right? That's what we owe at December the 31st, 2021. I wish they had used dates here, but I think it's because they don't want to keep updating the dates of the table as the editions of the book change. So just remember that this is the total liability at December 31, 2021. Now, if the question had to ask you at this date, how much of this liability is current and how much of the liability is long-term, you actually have the answer in front of you, because anything that gets paid within the next year, meaning this 11,800 reduction of principal, that is going to be current liabilities. And anything that's remaining after that, which is the remaining principal balance, 477,274, that is going to be long-term liabilities. Together, these two amounts take you back to 489,074. Can I repeat that for someone, or is there a question? Because this is, oh, sorry, someone asked me, can I please go up for a second? There.
Professor, my question is, when we record it, do we need to do both recordings? Or when do we do the one to explain? Like, yeah.
You mean this? Where I'm at now?
This and the one above. So which one do we need? How do we record it? Like,
Oh, you do both. The first one is to actually just show that you took out the mortgage. The second one is to show the first installment at December the 31st, 2021.
So the first one, we only do it when we get the mortgage, and
once.
Yeah,
once. Only once. You don't have to do it every year. Is that your question? Like, do you have to keep recording the mortgage every year?
Yeah, it makes a lot of sense, just making sure.
Yeah, you just record it once and then it gets paid off over time. Okay?
Yes, very clear. Thank you.
All right. Okay. So sorry, if you ask me something in the chat and I don't react, it's because I sometimes forget to look. So just interrupt me. I really don't mind. So, you know, just to reiterate, on December the 31st, 2021, this is the total liability. If a question asks you, at December 31st, 2021, how much of this liability is current and how much is long-term, which I know for a fact one of your homework questions asks you, and people struggle with that question all the time. You go and look at your table and you say, at this date, how much am I going to pay within the next year? Not the 50,000, because the entire 50,000 does not reduce the principal balance. Only the 11,800 reduces the principal balance. So this is the current liability, and then what's left over to be paid in more than 1 year is the long-term liability. All right, I know it's like I'm probably beating a dead horse here, but I know that every time the questions that I get on this chapter, it's got to do with this. And so the book explains it nicely. Also, they say the same thing, right? What is long-term and what is current. Any questions there before we go into an example? Any further questions? Okay, so we will look at exercise 7 together, Leonard Inc. And I will build the, I know that I went through this in the textbook, but I think it will be useful to everybody if I go through at least one round of building the amortization table with you, and we'll prepare the journal entries to record the loan and the first 2 installments, and then we have this classic question again, right? What amount is current and what amount is long-term in this scenario? So let me go back here where I was doing all the answers before. So I'm just opening up exercise 7 for myself. So exercise 7, you should have the handout, and it does not explicitly state to prepare an amortization table, but I'm going to do that, 1, to show you how to do it, but also 2, because it's sometimes a little bit easier to just see the answer in front of you. You can do a shortcut with these questions where you just calculate the interest for the first year and kind of just keep it moving, but I'll show you the amortization table. So Leonard Inc. issues a $600,000, that's the principal amount, right? Face value, principal amount, amount owed, whatever you want to call it, balance. 10%, oops, 10%, that's the annual interest rate. 5-year, so that's the term of the mortgage note on December 31, 2012, that's the issue date, to obtain financing for a new building. The terms provide not for annual, like the example we just saw, but instead semi-annual installments. So every 6 months there's going to be an installment, but the payment will be the same, right? The payment is $48,145 every 6 months. What this then means, though, is that we cannot just use 10%, because 10% is an annual interest rate. So what's in effect happening is that the semi-annual, I mean, this is very obvious, but I'll just say it, the semi-annual interest rate is 5%. So you have to take care when you do the interest calculation that you are in fact using, 5% or 10% times 6/12, or 10% divided by 2, so you don't overestimate the amount of interest. All right. So we start off by putting the headings. So if you want to follow the book, you can. I normally just call this payment date instead of interest period. So it's payment date, right? It's installment that you have, it's interest, and it's, we can say at 5%, because of, just to remind ourselves, because of the semi-annual thing, right? This is the reduction in principal. And then this is the principal amount. So we start with December 31, 2012, right? That's the issue date. And they took out a $600,000 mortgage. So again, no installments on day 1. We just put the $600,000. I'll give you a minute to catch up to me. I feel like I'm going fast. I don't know if I am, but I just have that feeling. All right. So on which date is the first installment going to happen? Do you guys think?
June.
Yeah, so June the 30th or July the 1st, whatever they choose, they don't tell us, but let's just assume it's June the 30th, right, 2013. That's going to be 6 months in. Why 6 months? Because of the semi-annual installment thing. So we just go for June the 30th here. So we go back and we say, okay, how much is the installment? 48,145. Great. So that amount is set, and we don't have to even think about it. In fact, we can, if we wanted to, not that you need to, but I'm just doing this. If you wanted to, you could just kind of copy and paste it right down the line, because it's always going to be the same. How do you calculate this interest? What did we see from the textbook? The interest is the principal balance times the interest rate, okay? So we know that it's 10% annually, but since we're doing semi-annual, we're going to say 600,000 times 5%, which is 30,000. Okay, so how did, again, the interest, how did I get that? It is the principal balance times the interest rate, which in this case is 5%. Okay, now how do you get the reduction in principal? If you go back to the textbook, you remember that the reduction in principal is the difference between the cash that you actually pay and the interest expense, right? Whatever is left over is the reduction in principal. So I'll just write it here. It's the installment minus the interest, so that you can remember.
18,145.
Correct. So 48 minus 30 is 18,145. And so the new principal balance is going to be the old principal
581,
amount
855.
minus, yeah, 581,855. Old principal amount minus the reduction in principal gives you your new principal balance. So this was 600,000 minus 18,145, in case someone doesn't know what just happened. All right. So the next date is going to be December the 31st, 2013, another semi-annual installment. So I'm going to give you guys about 3 to 5 minutes. Don't scream out anything. Just wait till everyone's done. Let's say 4 minutes. Okay, so 11:21, I'll come in and take the answer from someone. What I want you to do is to just finish this line to see if you understand how to calculate the amounts. To resume recording. Oh man. Okay, so I'll just do this so that whoever is looking at this, this is why I just should not even pause the recording. Okay, so for the first for the first entry, you're recording the mortgage note itself, and then for the second entry, you are just pulling from the line all the various items that you need. And just for the sake of the recording, I'll just say, since we didn't have it on, to get to the interest for the second installment, you're just taking the new principal balance and multiplying it by 5%, and you come out to 29,092.75. To get to the reduction in principal, it's the same approach. You're just subtracting that interest amount from the installment. And then to get to the new principal balance, you just subtract the 19,000 from the 581 to get to 562. That's just to close the loop on the recording. All right. So at December 31, 2013, it's repetitive, okay? It's the same entry, interest expense. You go up and you pull it right from there. You could, so you're saying 29,092.75. If you keep the decimals, you may just be able to round. It depends, again, like I said, on the instructions that you get in Wiley. And then the mortgage notes payable, you're also debiting. You could almost just press equals and pull the number down. Notice that the piece of the installment that's going towards the mortgage is slightly higher, right? Not by much, but a little bit higher. And that's because the interest drops, the interest expense drops as the principal amount decreases. Remember, we said on Monday that if you do have a mortgage and you decide to pay extra every month, that you have to make sure that you tell the bank to apply your extra payment to the principal balance, not to treat it as a prepayment. You can try to do this with student loans as well if you ever do have student loans. I remember when my husband had a student loan, we overpaid every month, but they refused to apply it to the principal. They just treated it as a prepayment for the next installment. So every place has different approaches. Most of the time, they're just trying to make more money off of interest. So that's why they might refuse you if you ask them to apply it to the principal. All right. So that's the borrowing and the 2 installments. Does anybody have questions for me at this point? All right, so now we go to the B part that says what amount will be reflected as a current liability and a long-term liability in the balance sheet on December the 31st. Notice the date, okay, very important. On December the 31st, 2012, what amounts will be current and what amount will be long-term. Don't shout anything, don't say anything. I'm gonna give you guys 3 to 5 minutes, let's say 5 minutes. Some people might be done before that, that's fine. But I'm gonna give you 5 minutes to spend some time looking at the amortization table, thinking about what I explained to you when we were looking at this amortization table, and try and figure out how much of this mortgage balance at December 31, 2012 is current and how much is long term. All right, so we have had our 5 minutes. So for part B, how much is the current liability?
$19,052.25.
Sorry, what?
$19,052.25 is the current.
I'm gonna say no
Isn't
to
it
that.
37,000?
Why is it no? What are you missing?
It will be the 80,000 less than 19,000.
Yeah, you got to add both, right? Because remember, current is what is due within 1 year. So let's take a step back and say at December 31, 2012, right? The total liability is 600,000. Of that, you have to ask yourself, how much money is going to be paid by December the 31st, 2013, right? Because that's 1 year. And
I
so
forgot we were doing semi. Oops.
yeah, don't go semi, go full. So remember, current is always what is being paid within 1 year. So if we owe 600,000 in total today, how much will we have to pay within the next 12 months? It's going to be excuse me, both of these amounts, because one is paid by June and the other one is paid by December. This is the year, right, from December 31, 2012 to December 31, 2013. So the total is actually 37,197 for current liability.
My question is,
37,197. Sorry, did someone say something?
yes, my question is the interest. Why does it not go?
That's a great question. So you are only paying attention when you are looking for the current liability. You're only paying attention to the amount that you are paying that is actually reducing the 600,000. The interest amount does not reduce the principal balance. So it's not part of the liability that is being paid off in future. In fact, the interest is just an expense that is going to be expensed through the income statement. It doesn't hit the balance sheet at all. Does that make sense?
Oh, I see.
So I know the temptation would be to say, well, in the next year we're paying off, what is this, 96,290. That's true. That's the cash that is leaving your pocket. But how much of the 600,000 is being reduced? It's only going to be 37,197, unfortunately. All right. And so if 37,197 is the current liability, then how much is the long-term liability?
Everything left.
Whatever is left over, right? So it's the answer is actually right here on the this is again why I say excuse me, the building of an amortization table can be very useful, because your answers are right there. If you're just doing like rough calculations on the side, it can become a little bit confusing. So after we've paid off these two amounts, what's left over is still the 562,802.75. So that's going to be our long-term liability, 562,802.75. And together, so it's basically the 600,000, which is the total liability, and you subtract whatever part of that is being paid within
You're missing
1
25
year.
cents on the current liability.
Oh, thank you. Good. So you should find that together, those two amounts, right? The amount that we said is current plus the amount that we said is long-term. You see on my screen, they have to add back up to the total liability on the date that the question is asking us about. December 31, 2012. Questions, people?
I made a mistake because on the homework is by a year.
Okay. All right. So mistakes are hopefully a little bit resolved now, right?
Yeah.
So what I'm going to ask you guys to do in the next, let's say, 7 to 10 minutes is I'm going to ask you to build out the payments for 2014. Okay, this is not, sorry, what am I doing? This is not part of the question, but I just want to do some extra practice using the same question. I want you guys to build out the installments that they would be making for 2014, just to kind of solidify your use of this process. And then after that, I'm going to ask you a similar question like part B, right? At December 31, but at December 31, 2013, how much is current and how much is long term? All right. So let's take 10 minutes to build. I don't know, 10 minutes probably too long. Let's take 7 minutes to build out these two rows, excuse me, and then I'll ask you the question about what is current and long-term at December 31, 2013, right? I'm not gonna pause the recording because I keep forgetting to restart it. So I'll still record. I'm here if someone has a question, but keep your answers to yourself until we come back to Okay, we're wrapping up. All right, so let's go. We know that the installment stays the same, right? That's been said numerous times. So hopefully that was obvious. The interest calculation, anyone want to take a stab at it? What do I do? Excuse me. Shall I help myself? That's okay.
It's going to be the principal amount left from December
Yeah.
31st, 2013 times 5%.
Yep. Great. So now the numbers are getting a little bit nutty. Yeah. So I'll
It's
just keep
28.
the two decimals. Did you also get 28,140.14?
Yes.
Yeah. Okay. Then you subtract that from the installment to get to the reduction in principal. And then what do you do?
So it's going to be 20,004.85.
That's right. And then?
And then we're going to minus the 562 minus 20,000. That's going to be the new
To
principal.
get to 542 as the new balance. And so you just repeat, right? Even the Excel is already predicting what I should be doing. They're saying, take this number, that's correct, and multiply it by 5%. So I'm getting, notice how the interest number is dropping, as I said, as the principal drops. And then we subtract that from the installment. And then the reduction in principal is subtracted from the principal balance. So you should have ended up somewhere in the arena of 521,792.78. Any questions there, or someone who ended up with totally different numbers? All right, so it seems like silence means that people are okay. So now I'm going to ask you the next question. What is the current liability and the long-term liability at December 31, 2013? Okay, you don't have to shout out anything. Take 2-3 minutes and think about what you think the current liability balance and the long-term liability balance is at December 31, 2013 at noon. I'll take a person who wants to help us to say what they think. Sorry, I'm off. I said noon. I meant 11:50. I'm obviously jumping, time hopping. Let's do 11:51. Okay, just All right, any takers? Current liability. Anyone want to take a wild guess?
It's
At
for
what the
14, right? 2014?
What's the current liability at December 31, 2013? So if you're standing on this date, how much of the liability will be paid off within 1 year? That's what I'm asking. Wild guesses are welcome. It doesn't matter if your answer is not correct.
$41,009 and
That's correct. That's correct. So I'll repeat because the sound is a little bit, maybe it's just my earbuds, but I couldn't hear you so well. So if I ask you, and the reason I'm going over this again is because people struggle with this all the time in the questions for homework or the test. If I'm asking you if Wiley's asking you, what is the current liability and long-term liability at December 31, 2013, what you need to know is your total liability is 562, right? On that date, 562,802.75. That number is split between how much of the number is going to be paid within 1 year and how much will be left over to be paid in more than 1 year. So 1 year spans from December 31, 2013 to December 31, 2014. Within that time period, there are 2 installments. Of those 2 installments, these 2 amounts are what actually reduce the principal balance. So those 2 amounts will become the current liability. So if it was just an annual installment, it would be 1 amount, right? But it's always the reduction in principal piece that is for the current liability. That's what's going to show up as the current liability. How much of the principal is being reduced, not the entire installment. I believe we just discussed that in the previous round of this example. So this is going to be $20,004.86 plus $21,005.11. That's how you get to the current liability. And now I know you might feel awkward because you're like, but those numbers relate to 2014. How can they be the current liability at 2013? But remember, you're looking ahead when you want to classify something as current or long-term. You're saying how much will be paid in the future. That's why we look at 2014 numbers. And then if that is the if that's the current liability, then what you need to say is for the long-term liability, basically I'm looking at how much was owed, right, at 2013, the total 562,802.75. Subtract from that the amount that I'm going to pay within 1 year. And so that looks very busy. So then you could ask, is there a faster way to get this answer? Absolutely. The amount of the principal that is still owing at the end of December 2014 is what will be paid in more than 1 year. So in fact, the long-term liability is just this balance over here, 521,792.78. Questions there? I know that this piece is sticky. It's sticky at times. Anybody need me to repeat something?
So it goes for the same thing when it says if the question changes to 2014, so it'll be 2014 then to 2015, right?
Yeah, so exactly. So you always, and I find that this is sometimes where people go a little bit wrong on these questions, is you always have to check for which date they are asking you, right? So just to your point now, if the question changes now again and says, hey, how much of the liability is current and how much is long-term at December 31, 2014, you can't go back to stuff that was already paid in that year. You have to look forward to things that will be paid in 1 year from this date. So to your point, which was correct, is that you then start looking at 2015's payments. And that will tell you how much is current and how much is long-term.
Thank you, Professor.
Mm-hmm. So the critical things here, read the question properly. As I mean, with any accounting question, that's obviously critical, but yeah, especially read the question properly to see the date at which they are asking you for current and long term. And when you have that date, you're always thinking 1 year ahead from that date to try and figure out what is current. And so you may have to do extra rows on your table to find out what is due within, 1 year from that date. The other thing to remember is that the current liability is not the installment amount that is being paid, but in fact only the reduction in principal. And by reduction in principal, we're talking about this part of the journal entry, right? If you're just doing this through journal entries, it's only this piece that is reducing the liability. And then finally, if it's a semi-annual situation, then the current liability has to be the sum of both installments that are happening within the year, because again, current is what is paid not within 6 months, but within 1 year from the date that you are viewing the liability from. So we've done this twice now. I hope that it's a little bit clearer for you. There is a homework. I've probably been timed out of Wiley already. I don't know. Oh, by some miracle, I haven't been. I'll tell you, I can't remember off the top of my head which homework it is. Maybe somebody else can help me. I'm just taking a chance here. Oh, good. I managed to guess it. So it's exercise 15-10, right? It's a whole mortgage note business. It's an annual situation. So at least you don't have to do, semi-annual payments, but they do ask you what is current and what is long-term at December 31, 2020. So sometimes I have people making the mistake when they're saying, oh, at December 31, 2020, this is what I paid, right? So this must be the current piece. And that answer is incorrect because you've already paid that amount. The question is what will be paid within 1 year from this date. And so you have to look to the next year to try and figure out what is going to be paid. And so that's why when you look at the answer here, it's telling you 23,328 is current, because that is the amount that will be paid 1 year from the date that the question is referring to. And for those of us who were talking about rounding earlier, remember that more often than not, Wiley gives you rounding instructions. So it's saying round to 0 decimal places. So please follow those instructions. Otherwise your answer might unnecessarily appear to be incorrect when it's actually correct, but you're carrying decimals. Any questions on this piece that I just showed you? Okay. So that's the homework question that is highly relevant to what we were just doing now. So at this time, I think what we can do is take 10 minutes, take a break. We'll fly through leases because it's really a minor topic and it's not going to take us more than probably 10-15 minute stops, and then I'll just kick off a little bit the chapter 17 work. So let's reconvene at 12:10, and then we'll go and look at leases. I'll be away from the desk probably for about 2 or 3 minutes, and then after that I'll be back. If people have questions for me, I'll take them during the break. Okay. Okay, I'm back if anybody needs to ask me anything.
Professor,
Yes.
I'm looking at the textbook 15.2, and I was looking at market interest rate and what bonds sell at. I noticed
Mm-hmm.
that it said that when a bond is sold, so it shows that the bond is currently at 10%, and then it says that above it is at 8%, and it says that that's a premium, but it's being sold for less. Isn't 8% is less than 10?
Okay, so let me go. This is for yeah, let me go in. I know what you're talking about. I also think I know the graphic that you're referring to, but let me go into it to just make sure that you and I are looking at the same thing.
Okay.
Or that what you're looking at is what I think you're looking at.
Illustration 15.5.
Yeah, illustration 15.5, you said?
Yes.
That one, right? Yeah, okay.
Yes.
So so let's talk about where the question lies. First of all, you have to remember that the bond itself, and I think you said this, but just to make sure, the bond itself is paying 10%, right? We're
Yes.
together on that. Okay. All right. This column says what the market is paying. So if the
Okay.
bond is paying 10 and the market is paying 8, that means that the bond is paying more than the market. So the bond is going to sell at a premium because people are going to want a bond that's paying 10% if the market is only returning 8%. So there's
Oh.
more demand. You have to read it like across, right? As
Okay.
opposed to, I think you were reading these three as like in a row and thinking, I don't know, I mean, if I'm wrong, but I think you were reading these three and saying, why is 8 a premium if it's lower than 10? But it's this is the market interest rate. All right.
Okay.
So if the bond is returning 10 and the market is also returning 10, you're basically breaking even and the bond will just go at face value because no one is going to want to
Yeah.
pay more or less because it's basically the same thing.
Yeah.
Make sense?
Yeah.
If the bond is returning 10, but the market is demanding 12, then the company will have to put the bond at a lower price because people can go elsewhere in the market and get a 12% return. So we would have to issue the bond at a discount to try to attract investors.
Okay.
All right?
Yeah. Okay. Thank you.
Okay, cool. No worries. All right. So the break's over, and we'll get stuck back into the last part of chapter 15. So just in case you're, if you, not in case, but I mean, you are following along in the textbook, the lease liabilities piece is kind of hidden under reporting and analyzing long-term liabilities. So you may go in and look for it and think that it's not in the textbook because they talk about, ratios and things. Many of these ratios we'll deal with in chapter 18, so you don't have to worry about that. But the lease liabilities is kind of close to the end of all the written stuff in this chapter. Obviously, you don't have to, I didn't assign it, and you don't have to read anything that has a star next to it because that's got to do with stuff that is additional, information that is not required for our class. So it's a very brief part of the chapter, and it's, like I said, it's kind of in a way hidden away. But if I had to ask any of us, since we live in New York, I'm sure we are familiar with leases and the fact that if you're renting an apartment or some family member of yours is renting an apartment, you would be familiar with the lease. You're also familiar with I'm sure other types of leases. So when a company decides to lease some asset, it's usually through a contract. There's the owner who has the asset, who's also referred to as the lessor, and then the renter is the lessee. And there are two types of leases. The book doesn't explicitly call them this because they've changed the content of the book a little bit. But one is an operating lease, which is, and I wrote this here. You guys don't have this in your notes. If you do have the notes open, you can add it. This is for a lease term that is less than or equal to 1 year. All right, that you treat the lease this way. And of course, I mean, if you are renting and you have a 2-year lease, that doesn't mean that you're suddenly the owner of the lease and you have to treat it. The owner of the leased asset, and you have to treat it differently. But sometimes companies lease like big assets, and they kind of try to act as if they are not getting all the benefits of ownership from that asset, so they don't want to put the lease liability onto their books. So the Financial Accounting Standards Board, which is the body that creates accounting standards, is always trying to make sure that companies are appropriately reporting their assets and liabilities on the balance sheet. So we'll see later on when we talk about a capital lease how they require companies to show that. So an operating lease or lease that is less than or equal to 1 year is for temporary use of a property by the lessee while the lessor continues to own the property. So this is the classic way who has the risks and rewards of ownership is, if you're staying in an apartment that you are renting or leasing, if something breaks, for the most part, it's not your responsibility unless you actually deliberately broke something. But let's just say suddenly the water is out or the heat is out or whatever. It's always going to be the landlord's responsibility, right, to fix that stuff. They have to bring in a plumber or if there's other stuff that they have to do. So that tells you that the risks and rewards of ownership, that's one example that tells us that the risks and rewards of ownership are with the lessor, who is the landlord, and not with you as the lessee. And so what are the journal entries when we are leasing? So in this case, they're assuming that the company is the lessor. So the companies may be leasing out a part of their building or whatever. This is, kind of obvious. You receive cash. So, imagine that you are your landlord and, the landlord is the company that you're accounting for. You debit cash because cash is being received at the beginning of every month, and you credit rent revenue. Revenue is obviously increasing on the credit side of the account. So that's how you would record it if you are the lessor. If you are the lessee, so like most of us, if we're renting, if you're the lessee, the rent is going to represent an expense to you, right? And expenses increase on the debit side. So the rent expense will be debited and cash will be credited. Cash, the asset, goes down on the credit side. And it's as simple as that for a lease that is less than or equal to 1 year. An operating in lease where you are not getting the risks and rewards of ownership. Questions on that? Anybody? All right. So it seems like it's fairly obvious, right? So a capital lease, the book doesn't necessarily call it a capital lease, but that's kind of what we refer to it as. This is leases for a term greater than 1 year. So if you look in the book, they preface this little journal entry here for all leases greater than 1 year, right? They tell you how to record it. So it's basically this, because it's greater than 1 year and depending on the nature of the asset and so on, it's like all the benefits and risks, or if we call it risks and rewards of ownership, have passed on to you almost as if you purchased the property. If you've ever worked in an office and they lease, let's say, the copying machine or the printer or something, by the time the lease is up for the printer in the office or those large photocopy machines, the thing is basically used up, right? It's kind of almost useless because it's been used for so many years. So it's almost like you're buying the property, even though you don't actually own it. So what the FASB says is, look, we know that you entered into a lease agreement, but the reality is that it is as if you own the property, so you need to treat it as such, which means you need to have an asset on your books to reflect the property that you own, and you also have to have a liability for all of the lease payments that you will be owing in the future. So you can imagine that some companies are not that excited about this. Often airlines lease the fleet of planes that they fly, and in the past they always tried to argue that because it was a lease, they could just kind of do this journal entry, when they pay the rent or the lease amount, and they didn't have to actually put the asset or the liability on their books. The FASB said no, because there's a risk there. Users wouldn't realize that you actually owe a lot of money, because if you go into a 5-year or 10-year lease, you are contractually bound to pay that amount of money, and people need to know, right, for current and long-term liabilities, how much money you owe. If you try to do this journal entry and ignore the liability, then no one actually knows how much money you owe. So think about the current situation we find ourselves in, with a lot of airlines, their flights being grounded, or they're flying at very low, percentage of flights that are actually taking off. And so if they were not forced to show these liabilities, for instance, investors may not realize, how much money they have to pay to like a Boeing or whatever, manufacturer they are leasing from. And that can result in people making, decisions about whether to buy stocks or whether to loan them money and so on, that are actually incorrect because they are not showing the liability. So as a result of all of this, the FASB said for any lease term that is greater than 1 year, especially for the types of things that large companies lease, you just have to record an asset and you have to record a liability. And so, some companies not excited about that because they don't want the liability on their books, but they don't have a choice. Please, if you are using the notes, just remove this final bullet because it's not relevant at the moment. And so you can either debit something called leased asset, or the book also calls it sometimes a right of use. I'll show you here. Right of use asset. They mean the same thing, but I just want to make sure that you know both, so that when you are working in the computer system, you're choosing, I guess, the name that is going to correspond directly with what Wiley is asking for. Questions on the lease that is lease term greater than 1 year? All right. So if we don't have any questions, let me go to this last exercise very, very quick. Like I said, this is not a major topic. And we will just go through and see what the journal entries would be for these two different scenarios. So this is exercise 8, which is the last exercise that we have for chapter 15. Prepare the journal entries that, and yeah, you want to be careful, right, that the lessee, so the person who is actually leasing the asset, should make to record the following transactions. In an operating lease transaction, so this is a lease that is less than or equal to 1 year, the lessee makes a lease payment of 100,000 to the lessor. So again, you are in the position of the lessee. So let's go ahead and I'll just go into we'll just wrap this up really quickly. So for number, did I call it number 1? You are the lessee, so you are going to debit rent expense, right, for the 100,000 that is being paid, and you're going to credit cash. And the reason you're doing this option and not the other one with the right of use asset is because this is an operating lease that is less than 1 year. So you don't have to record the asset or the liability. Questions on that? Okay, so then the second piece, sorry, that's not where I need to be. The second piece is going to be for a lease that is more than 1 year, or capital lease, however you want to call it. Hollard Company leases a new building from Crown Company. Remember, we are Hollard, we are in the position of the lessee. The present value of the lease payment is 550,000. What does that mean? Right, have you guys ever heard of the term before, maybe in some of your other classes, present value?
The current amount?
I need more than that. What do you mean by current amount? Or if that's your answer, it's okay. I'm just saying that that's not going to be fully the full answer for present value. Okay, so no one else is speaking up, so I'll just try to explain it a bit more. I'm going to use part of the words that you said, Jimmy, in the answer. So we can say the current amount, but it's going to be the current amount of what, right? So the present value of the lease payments is saying that for all the lease payments that we are making over time, so let's say this new building is being leased for 20 years, for argument's sake, right? For all the lease payments that are going to be made over the 20 years, whether it be annually or monthly or semi-annually, the value of all those payments added up today, you know, and discounted, meaning like brought to the present at some interest rate, is 550,000. All right. So maybe over time they're paying, you know, X amount of dollars a month. But if I had to say, what are all those payments over all those years worth today? It's 550,000. And the fair market value, you guys know what this means. The fair market value of the building is 600,000. That's what the building could be sold for today. So now the question is, which number do we record, right? Do we record the present value of the lease payments, or do we record the fair market value of the building? So the rules tell us that we have to take the present value of the lease payments, because that is, I mean, we're recording a lease, right? So we have to record the amount that is actually related to the lease, because the fair market value might be relevant, but the reality is that we can't necessarily just record what we could be selling this building for. We actually have to record the present value of the payments that we will be making. And then they also tell us that the lease transfers ownership to the lessee at the end of the lease. That's great, but we kind of already surmised that this is going to be a lease where we have to record that right of use asset. So you can debit, and I'm going to follow the book's language, debit a right of use asset, which is basically another way of saying a leased asset, for 550,000. Again, notice the present value of of the lease payments is what I'm using. And if you go into the book, I just want to show you the book does the same, right? The present value of the lease payments is 190. That is the amount that they are recording. And so the credit goes to lease liability. So this company is now going to have an asset and a liability on their books related to this lease, because the accounting rules state that they should treat this lease as if they are effectively the owner of the building. Questions, anybody? All right, so that concludes chapter 15. Hopefully, sorry, my daughter's losing it here in the background. So hopefully you guys will be able to systematically work through the various topics that we have covered from the start, where we did the bonds at face value, at a discount, at a premium. Then we did the retirement of the bonds at and before maturity. I told you that you can kind of skip over the conversion because the book isn't really that into going over the converting the bonds piece. And then the other big part of work that we have is the long-term notes payable, specifically the mortgage, where you have to do amortization and stuff. And then, like I said, leases is an incredibly minor topic that is definitely not a focus of the chapter, but still does fall into the long-term liability category of work. And I just want to see if. And yeah, I guess the last thing that I'll do here before I just give you kind of a preview of what is to come in our next chapter is we've been talking about the balance sheet a little bit as we've gone along, especially when we're doing bonds. I just want to show you that in the book, they do have here in illustration 1515, they do have an example of a partial balance sheet showing the bulk of what we have been discussing, right? So remember, we said that bonds payable will always be shown at face value in the balance sheet, and then you either subtract the discount on bonds payable, or if there's a premium, you add, the premium on bonds payable. In this case, they did a discount, but if you want to see how to add the premium, you can go into the bond transactions part of the chapter. So that would be the carrying value of the bond at 920,000. Then they show the long-term portion of a mortgage. Remember, the current liability would be further up in the information under current liabilities. So this 500,000 represents anything that needs to be paid in more than 1 year from the balance sheet date. We don't have a date here, but whenever you're looking at something long-term, you refer to the balance sheet date, and it will tell you that from that date, these things are owed in more than 1 year. And then the lease liability, which is the journal entry that we just completed, the 440,000. This is, these are not numbers that we were working with, but I'm just showing you that they're showing the 440,000. So this is obviously a lease that was for more than 1 year, where the company has to record the liability, and then the sum of these three numbers is the total long-term liabilities. So that, excuse me, that would be the long-term liabilities section of the balance sheet that kind of, I guess, brings together all of the varied topics that we discussed in this chapter. Remember that, again, companies can raise capital, raise funds. I shouldn't say capital because that can be confusing, but let's just say raise money by either issuing equity, meaning selling stocks, or by borrowing, by issuing debt. So again, this whole chapter is just the debt side of a company's raising of funds. All right, so this just shows you how these things flow into each other. And then, as they say over here, also the current liabilities are shown separately for things that will be paid within 1 year. Okay, So that's chapter 15. Your homework is due next week, Wednesday at 11:59 p.m. Don't, leave it till the bitter end because there's a lot of work to do there. We don't do chapter 16 in this class. The investments work will be done with, anybody who plans to see me again or not me, but plans to continue with accounting may see me in intermediate accounting too. That's where we discuss investments at length. So we skip over that and go to chapter 17, which is the statement of cash flows. So now, just to give a little bit of a setup. Obviously, we'll carry on with this more in Monday's class, but the statement of cash flows is, of course, a financial statement. I think that's kind of hopefully somewhat obvious. So you've got the income statement, you've got the balance sheet. Sometimes there's also a stockholders equity statement that further breaks out the stockholders equity section of the balance sheet, and then you have the statement of cash flows. Now, what's interesting about the statement of cash flows in the way that most companies prepare it is that creating a statement of cash flows is actually, or being able to create a statement of cash flows is actually very dependent on our ability to understand what goes into an income statement and what goes into the balance sheet, because the income statement and balance sheet, much of the information that's in those two statements is actually used to create a statement of cash flows. So why do we care, right? Why should we even have a statement of cash flows? So basically, the income statement and the balance sheet are prepared on what we call the accrual basis of accounting. And if you forgot what that is, not that I'm saying that you necessarily want to go back to this, but in chapter 2, from accounting 1, there's the full discussion about what accrual accounting is. I'll just talk about it a little bit here, but and we'll talk about it more on Monday, because we kind of have to go back and forth between these concepts in order for us to understand the work that we have to do to create the cash flow. So accrual accounting, as opposed to cash accounting, right? Accrual accounting says that we record the transactions as they happen, all right? And it doesn't matter whether cash has been received or whether cash has been paid. The transactions are still going to be recorded when they happen. So that then means that sometimes you can, for instance, have revenue that you have not yet received in cash because you still have accounts receivable. Or you could have expenses or other things that have not yet been paid in cash because there's still accounts payable. So the income statement is very useful for you to see how much net income you have actually earned at the end of the year, but net income is not necessarily the actual cash in the bank. So I'll give you, I guess, a typical example that you could possibly relate to. If you're working and you're being paid bi-weekly, meaning you're being paid every 2 weeks, right? If you worked for 1 week, you've effectively earned 1 week's salary or wages, but your bank account does not reflect that yet because you have not yet been paid. That's accrual accounting there, right? Because you're working and then you're being so you're earning the amount of money, but you are only receiving the cash later. So in your mind, you can say, okay, I've earned a week's worth of wages, but if I look in my bank account, it's zero because I haven't yet been paid. So with companies, sometimes kind of the same thing. Like you look at their income statement. Let me see here if I can just find. I know this chapter sometimes has income statements. Not sometimes it has income statements. Well, it's probably going to be under preparing. Yeah, so let's just take this for example, right? Here's an income statement of a company. It shows how much sales they had, all cost of goods sold, all the expenses, and the income tax. We just did income statements in chapter 14. Then it comes out to net income of 145,000. That looks great. They made a profit there. They made a net income of 145,000. Now the question is that also the same amount of cash that they earned or collected during the year? And the answer almost always is, what do you think? Is it yes or no? Do you think that net income is equal to the amount of cash that the company received over the course of the year? Yes or no?
No.
Yeah, no is the correct. Just like with you, if you work for 1 week and someone says, "Oh, you're working, you must be flush. Your wallet must be full of cash." You have to say, "No, actually, I earned 1 week's worth of wages, but I'm still waiting to be paid." Right? So. And or I already bought stuff on my credit card, so some of the money that I'm gonna get in cash I have to pay off automatically on the credit card, so I'll never have the same amount of cash in my bank account as the amount of cash that's on my pay stub. For instance, for companies it's the same. Just because you have 145,000 in net income, that's the accrual accounting profit, doesn't mean that 507,000 of sales revenue was actually already collected in cash, because if there's accounts receivable for some of this money, then the company did not receive everything in cash. Similarly, for some of these expenses, right, there's 111,000 that's been recorded as expenses, but all of these expenses were not necessarily already paid in cash. Accrual accounting says you record the expenses as they happen, but some of them may not have been paid, so there's still accounts payable or accrued expenses. So what is the purpose, right? When we say, what is the purpose of a statement of cash flows, right? Why do we care? For those of you who, zoned out now, if you fell asleep a little bit while I was talking, why do we care? We care because a company may look really profitable on the books. They might have a big net income, but they will not survive if they don't have cash, right? So the statement of cash flows actually shows us how much cash came into the company, right? How much cash came into the company, how much of cash went out of the company. Is the company able to generate cash? So are they actually collecting cash from the customers? Are they able to pay their bills and so on? If any of you have ever had a small business, or you have family members who have a small business, or even dealing with your own finances, right? You know that obviously bills come due, and let's just say you loaned money. This is hardly ever a good idea, but it happens. You lent money to some family member, and now you're waiting for them to pay you back, but your bills are also due. Then you're going to you can say, yes, in theory, I have money out there somewhere because someone is supposed to pay me back, but your bills are coming due, so you don't have the amount of money on hand that you need to pay your bills, right? So for companies, it's the same thing. They might be generating a whole lot of business, but if it's not a cash business, if people can buy on account and they have 30 days to pay or 45 days to pay and so on, if the company isn't good about collecting from their customers and bills are coming due, then they're going to have a cash crunch. And they may not be able to stay in business. What's happening now in our current environment, unfortunately, as we see how companies, small businesses and others are going out of business, they have less cash coming in because they're not making as many sales, or people who owe them money are not able to pay because they themselves are struggling, but the bills are still due. So now suddenly an income statement almost becomes irrelevant to some extent, because it may look like you're profitable because you made all these sales in January and February, but no one is actually paying you the cash that they owe you. So from a cash flow perspective, you are not able to stay in business. And this whole notion of cash is king, and you know, you have to be able to have cash to pay your payroll, to pay your suppliers, and so on. That is why we have to build a statement of cash flows, because it shows the users that the company, not only is the company profitable, but the company actually has the cash that it needs, right, to pay everything that comes due. So next week when we come together, and I mean, the handout, it's over here, the handout is there, and you can read some of the stuff, and obviously I'll go through this with you next week. But next week when we come together, we'll actually start talking about, you know, what the cash flow statement looks like, how cash flows are classified, you know, also what types of cash inflows and outflows are we dealing with, and we will make our way slowly to the point where we can actually prepare a statement of cash flows from scratch. I will warn you again, I said this before, you know, I'm always honest with you. Statement of cash flows is one of the most difficult topics in accounting, all right? And the reason it's difficult is because you have to understand how an income statement and a balance sheet work, and you also have to understand how to classify, you know, the cash flows, and you have to move basically away from accrual accounting into cash accounting, which is a little bit of a flip, you know, that we're not asked to do all the time. If you stick with me, and I mean, I can say this because I've taught this class many times and I've seen it. If you stick with me and you keep up with the material, you will be able to do a cash flow statement with ease by the end of our time together. But if you know, if you cannot attend the lectures, then you should listen to the recordings as soon as possible. But if you kind of are just floating around and not really paying attention to what's happening in the lecture, it's going to be very difficult to do a statement of cash flows, just because this work is absolutely very hard. So I expect to repeat myself many times. I want people to come with questions. I want you to stop me and tell me that you don't understand something that I'm saying, because like I said, I already know that this chapter is difficult. The one after this is very, very easy because it's like formula driven. But you know, by all accounts, chapter 17 or statement of cash flows in accounting is going to be one of the harder things that you've done. This is not said to scare you. I'm sorry if you did become scared now. That's not the point. The point is to say it so that you are prepared. And if by any chance you even have 10 minutes to read through this handout, let me see how many pages we're actually talking about. Not many, it's like 3 or something pages. Please, even if you just read the synopsis that I'm giving in the handout is over here on the Zoom call materials. Even just read that before our next time together on Monday. It's already going to give you even a little bit of a view into this chapter. All right, so again, sorry if I sound like I'm trying to scare people. That's not the point. I will just hang on. The point is that I don't want to leave anybody behind. You guys have kept up really well up to now, but I would be remiss if I didn't warn you that this chapter is hard. I have a question here about the midterm or final exam as 3 or 4 attempts. All the tests, all the exam as 4 attempts. So I at least that's what I think. I mean, you can always tell how many attempts are available when you go into the thing. It tells you on the landing page. You just have to take a moment to read. It tells you on the landing page how many attempts you have. For homework, it's unlimited, and I think for the tests, I would have to go back because I can't remember, you know, offhand, but I think it's 4 attempts. You see there, up to 4. So please, when you go into the tests and stuff, it's normally 4, but you can always see what I've done by just looking at that landing page when you get in there. Any other questions before we hang up here?
Yeah, what's the next date of the test?
All right, so that you guys can print this thing. I'm going to show you now, okay, where you go, and please print this or take a picture, whatever you see on Blackboard. It says due dates and assignments. If you click on there, it's got everything that you need to know, right? So chapter 15 homework is the thing that is most pressing right now. It's due next week, Wednesday. Then we still have to get through chapter 17 and do the homework for that. The next quiz and test is about chapter 15 and 17. It opens on May the 24th. That doesn't mean you have to do it on that day. I'm just opening it on, excuse me, a Sunday, in case some people are confident enough that they feel like they can just get it done. I'm opening it that Sunday, but you can also wait, because on the Monday I will go over the homework, for chapter 17, and you'll be able to ask me questions, but you have a whole week to finish. By a week to finish, I mean, you can do the test and the quiz at any point during that week. It's still the same idea. It's timed. I'm giving you 4 hours for the test, which is about double the amount of time that I normally give. And the quiz is 2 hours. It's the same kind of setup as before, like as the ones you did before, but I will give you a test and quiz, the whole sheet, the prep sheet, long before you have to do the work. All right?
Okay, thank you.
Okay. Other questions?
Professor, so today was on chapter 17 notes? Wait, no, because we didn't do chapter 15 homework yet.
Yeah, I don't understand the question. Are you asking me, what are you asking me if today is, are you asking
Okay.
about that?
Okay, so posted under solutions on S20, right? What is the chapter notes for today?
We finished chapter 15 today, so everything
Okay,
that
so 14 and 15.
related to chapter 15 is in the exercise solutions.
Okay.
All right, and then I already put the chapter 17 stuff there, but I mean, we've only really done a setup for chapter 17, so I wouldn't, I wouldn't spend too much time there, because you'll be able to get through that stuff next week after I teach it to you. All right.
Okay, so we were doing chapter 14 on Monday.
14, we already went through that.
Oh, okay, so it was 15 on Monday, and then we were continuing.
Oh, you're asking me this past Monday. Sorry, I thought you were asking me about next Monday. No, this past Monday was chapter 15. Mm-hmm.
Oh, okay, yeah, so 15 for these 2 days. Okay. Yeah, I copied 14 solutions already. Okay. So I just have to
and as
finish up
soon
with
as
15.
Wednesday passes, the 13th passes, I will put the full solution for the chapter 15 as well, so that you guys can practice more questions if you want to.
Yeah.
Mm-hmm. All right, guys, you're dismissed. Thank you so much. Have a lovely rest of your day. If anybody else wants to stick around to ask me questions, I'll still stick around here for a few minutes. No problem.
Thank you, Professor. Take care.
All right. Good luck with your test. Bye.
Thank you, Professor.
Okay.
Thank
You're
you,
welcome.
Professor. Have a nice day.
Bye.
Bye-bye.
Take care.
You too.
Take care, everyone.
Bye.
Professor, I have a question.
Yeah, go ahead.
Okay, for towards graduation, right? Let's say you need like 3 classes left, and then you need like an intent to graduation class that doesn't give you any credits. So the 3 classes I'm talking, it's a total of 9 credits. So does that mean I have to pay? Because full time is considered 12 credits.
For financial aid.
Yeah, I have financial aid. I do.